The broadcast is now starting. All attendees are in listen-only mode.
Good morning, ladies and gentlemen, and welcome to our webinar on the Lifetime Allowance and Benefit Crystallisation events. My name is Andrew Penny, Marketing Director at Intelligent Pensions, and I'm joined today by the ever more technically gifted Steve Patterson, Managing Director at Intelligent Pensions. Now, just a couple of housekeeping issues first. You are all on mute and will be for the duration of the webinar, so feel free to shout and curse at us as much as you like. On the right-hand side of your screen, however, you will find a control panel, and from there you can enter questions by typing them into the appropriate box. And we will have time for Q&As at the end, so please do send your questions through. You will also find our fact sheet in the available downloads in this panel, which is also available via our website. And you can raise your hand if you're having any issues, and we will try and help. So on to the webinar and the insidious tax that is the lifetime allowance, which looks set to catch more people out in future as the allowance is cut further. Now, as most of you will be aware, we have written a detailed technical guide on the lifetime allowance, which runs to some 21 pages and can be found on our website. We've also tried to break the lifetime allowance subject down into more manageable topics, and this webinar comes on the back of our first of 4 fact sheets and specifically looks at the lifetime allowance and benefit crystallisation events. Now, over the next 2 or 3 weeks, we'll be sending out 3 further fact sheets on the various lifetime allowance protections available and also the impact on defined benefit schemes. And we'll plan to running another sweep-up webinar, probably in September, when everybody's hopefully seen a bit of sunshine and had a holiday. Now, before I hand over the reins to Steve, I just want to ask you a quick question, which should come up on your screen now. Your responses are anonymous. This question will also be asked as part of the very short feedback survey at the end of the webinar, just so we can see if there's any change in your views having gone through the webinar and looked at the case studies. So just waiting for people to vote there. Okay. I already won that. Sorry. Right, well, thank you for that. I'm now going to hand over to Steve to take us through the main body of the presentation. And as I say, keep your questions coming in and we'll come to them at the end. So Steve, over to you.
Right, thanks, Andy, and good morning, everybody. This is, as Andy's explained, primarily about the lifetime allowance. It's not so much a technical session, although I'm going to set the scene with some background information. It really is about the planning issues involved and some of the aspects of the less obvious pitfalls surrounding retirement planning and the lifetime allowance. As you'll be aware, the lifetime allowance was introduced in 2006 under pension simplification. Initially, the LTA was set at 1.5 million, with a series of predetermined increases over 5 years, reaching 1.8 million in 2011-12. For people whose benefits were over this limit, or who thought they would go over the limit, they could apply for either primary or enhanced protection. An individual could claim for primary protection where their benefits were valued at more than 1.5 million at 5th April 2006, and they have a personal lifetime allowance set by the value of their pension rights on that date. Until 5th April 2012, these personal lifetime allowances under primary protection were adjusted annually in line with the standard lifetime allowance and are now effectively frozen at the 2012 level. Enhanced protection could be claimed by anyone, including those with pension rights of less than 1.5 million at April 2006. Enhanced protection fully protects the value of an individual's pension rights on 5th April 2006, regardless of ongoing growth. However, there must be no further accrual of benefits above a specified level of indexation, and no contributions can be made to money purchase arrangements. Now, most people expected that the LTA would continue to increase broadly with inflation. Instead, in 2012, the coalition government reduced the LTA back to its starting point, with provision in the legislation for people to protect themselves against the effects of this, subject to certain conditions. A new form of protection called fixed protection was introduced ahead of the reduction to 1.5 million. Fixed protection, or as we now call it Fixed Protection 2012, allows individuals to crystallise benefits worth up to 1.8 million without paying an LTA charge, although their ability to accrue future benefits is limited. A further reduction took place in 2014, and the current LTA stands at 1.25 million, with further provision for people to retain the 1.5 million if they hadn't already obtained protection at the 2012 limit. From 6th April 2014, there's a new form of protection called Fixed Protection 2014, or FP 2014, that will allow the member to crystallise benefits worth up to 1.5 million without paying the LTA charge, although again the ability to accrue future benefits is very limited. Members don't need to have already built up pension savings of more than 1.25 million to apply for FP 2014, but they must have been a member of a registered pension scheme at April 2014, not have primary or enhanced protection or fixed protection 2012. Individual protection 2014 gives the member a protected lifetime allowance equal to the value of the pension savings at 5th April 2014, subject to an overall maximum of 1.5 billion. Clients won't lose IP 2014 by making further savings into their pension schemes, but benefits in excess of the protected lifetime allowance will be subject to an LTA charge. IP 2014 is available even if your client's pension savings on 5th April had a value of more than 1.5 million. As the maximum protected lifetime allowance with IP 2014 is 1.5 million, any savings in excess of this will not be protected and will be subject to an LTA charge when benefits are crystallised. The LTA is to reduce again to £1 million with further protection available, and is then set to increase from 2018 onwards in line with CPI. In 2016, transitional protection will be provided similar to the 2014 protection regimes. So as we stand, there are three LTA levels at 1.8 million, 1.5 million and 1.25 million, none of which can realistically be expected to change. The new LTA of 1 million will increase with CPI from 2018, and so eventually should overtake the current limits. This is the position assuming CPI averages 3% per annum, and shows that the 1.25 million LTA could be overtaken within the next 10 to 15 years, 1.5 million in the next 15 to 20 years, and 1.8 million in 20 to 25 years. This obviously raises a number of issues. Firstly, from an advice standpoint, the likelihood of the LTA being abolished at some point has reduced as a result of the new CPI linkage. Secondly, the potential impact of the lifetime allowance could affect many clients in the longer term whose funds are currently nowhere near the £1 million mark. That in turn has a bearing on advice regarding ongoing contribution levels as well as investment strategy. Here we look at the position for a client who currently has a £500,000 fund with no further contributions being made. This shows that at a 2% net real rate of return, measured against CPI rather than RPI, the LTA would be unlikely to be breached over 30 years. This would be considered a relatively low-risk investment strategy. Of course, if ongoing contributions are being made, that exacerbates the problem. However, at 5% real rate of return, even if protections are available, there's a far greater likelihood of the LTA being breached. A more aggressive investment strategy could therefore be penalised. This is a problem for advice, especially given the unknowns. For example, what will CPI be in the years ahead? what fund growth rate will be experienced in practice, how will future contributions, for example from an employer, impact on the result. In one sense, employer contributions aren't a major issue. It's really the client contributions that are more important. But the impact on these will depend in part on how much an employer is contributing. However, telling clients to stop contributing prematurely also has potential consequences. They will obviously pay more income tax. They could also be increasing their taxable estate and thereby potentially lose out on the new favourable tax treatment of pension death benefits. So simply diverting savings into ISAs, for example, is not necessarily best advice. So this is a planning conundrum, and planning is key. Benefit crystallisation events occur when people take pensions or lump sums, when they reach age 75 or die before age 75, or when they transfer to a QROPS. There are currently 12 BCEs, 4 of which have been added in the last few years, including BCE 5C, which was added from April 2016. They are BCE 1, where funds are designated to provide a member with a drawdown pension, BCE 2, where a member becomes entitled to a scheme pension, whether from a DB arrangement or a money purchase arrangement, BCE 3, where a scheme pension already in payment is increased beyond a permitted margin, BCE 4, where a member becomes entitled to a lifetime annuity under a money purchase scheme, BCE 5, when a member reaches 75 under a DB arrangement without having drawn all or part of an entitlement to a scheme pension and or lump sum. We then have BCE 5A, which is where a member reaches 75 with a drawdown pension or flexi access drawdown. This is often known as a second crystallisation event, as benefits which were tested under BCE 1 are retested, and this is a particularly important planning point, and I'll be demonstrating this in the case study that we're doing. BCE 5B, also important, where a member reaches 75 under a DC arrangement in which they've got remaining unused or uncrystallised funds. And the new BCE 5C, where a member dies before their 75th birthday, and unused crystallised funds remaining at death are designated on or after April this year, but before the end of a 2-year period, to a dependent's flexi access drawdown or a nominee's flexi access drawdown. BCE 6, where a member becomes entitled to a relevant lump sum. Not all of the authorised lump sum payments are relevant lump sums. BCE 7, where a relevant lump sum death benefit is paid on the death of the member. BCE 8 is transferring to a QROPS, and lastly BCE 9, where certain payments are made to or in respect of a member that constitutes an event that's prescribed in the regulations. For example, these are currently payments of any arrears of pension after death, any lump sums based on pension errors, and PCLS type lump sum paid after death. Okay, today's presentation isn't really about the technicalities surrounding the LTA or the whys and wherefores of the application of BCE rules. It's about key planning issues when advising clients on their approach to retirement planning. Many clients don't understand and won't be aware of the potential implications. Others will assume that as long as they take their benefits before they reach the lifetime allowance, they won't have a problem. We've actually seen examples where the potential tax charge is a high 6-figure sum, so this is a serious planning issue. Those with DC benefits on top of DB pensions are particularly at risk. And lastly, relying on the LTA being abolished is a high-risk strategy. Okay, so our case study, and this is actually a fairly run-of-the-mill type of case. It involves a retiring NHS consultant He's got a gross NHS pension from 60, which is just over 41,000 a year. He doesn't have any fixed protection, so his LTA is 1.25 million. The LTA used up by his NHS pension is about 75%. So this leaves 315,000 of unused lifetime allowance. He's currently a personal pension of 200,000, which has been funded out of his private consultancy earnings, and he plans to continue doing private consultancy work up to state pension age, but on a full-time basis. From this, he expects to generate around 80,000 of fees annually. That means his combined gross income is therefore over £120,000 a year. Now, having considered this, you may well advise him to pay £21,624 a year, the excess over £100,000, to avoid him losing any of his annual allowance and thereby incurring effectively a 60% marginal tax rate on the top slice of his earnings. Okay, his personal pension, with the additional funding and ongoing growth, and let's say that that grows to 466,000 by age 66 when he intends to take his benefits. And at that time, he wants to use Flexi Access drawdown rather than buy an annuity at least up until age 75. This is taken from the LTA computation model on our retirement analysis system. Firstly, looking at the left-hand side, we see the current plan value of £200,000. Below that, the client's current personal LTA and the proportion of that already used up, around 75% in this case, and the LTA remaining of 315,000. On the right-hand side, we have the projected benefit crystallisation events. The projected value of his personal pension is 466,000. This would use up a further 37% of his LTA, resulting in him exceeding his lifetime allowance by 12%, and thereby incurring an LTA charge of around £95,000, which obviously is not ideal. The potential problem is that by recommending contributions be made to mitigate income tax at an effective rate of 60%, an entirely appropriate recommendation in this case, there is an accumulation of excess fund that results in a projected LTA charge of around £95,000 at age 66. This is, of course, based on the assumption that he doesn't crystallise any of his personal pension benefits until then. Of course, if he defers some or all of the crystallisation of his personal pension until even later, then the problem will only get bigger. Let's also consider the position in the context of his wider financial needs and his expected income requirements in retirement. This analysis from our retirement analysis system shows his tax-free cash coming out at 66 and the income after tax in the period up to retirement and then from retirement to 75. It assumes that the amount taken in drawdown from his personal pension is what is needed to meet his expected income requirements. It also shows his long-term needs after 75, all expressed in present-day terms. One of the benefits of this type of analysis is that it's fully interactive. For example, we can run any range of what-if scenarios the client wants and instantly see the long-term effects. We can also factor in external incomes, for example, the state pensions for both spouses, as well as investment income and other pension sources to create a complete financial model, although I've deliberately kept things simple here. So let's now consider the position if he crystallised all of his current personal pension benefits now, taking his tax-free cash, but deferring the pension to 66, while building up a secondary personal pension pot through the ongoing contributions. So he takes his current personal pension tax-free cash now, crystallising that fund in full. For the purposes of the case study, I've also assumed that he uses his initial drawdown fund to meet his full income requirements between retirement and 75 and defers crystallising any of his second personal pension pot until 75. Here we can see that by crystallising his current fund, which has got up to just over 200,000, he uses up another 16% of his LTA straight away, taking his total up to just over 90% and no LTA charge at that stage. The secondary personal pension plan just carries on growing and growing, and that results in a BCE5B value at 75 of £348,000. Even if he didn't crystallise the second plan and take the tax-free cash at 75, BCE5B is a deemed benefit crystallisation at that time based on the value on all uncrystallised funds. This is then measured against the amount of any unused LTA at that time. In this case, for example, it would not be his personal LTA 1.25 million, but the projected 2016 LTA limit adjusted for CPI to age 75. The excess is then subject to the LTA charge, and this gives rise to a tax deduction of around £120,000, albeit deferred well into the future. So let's now look at the position if he not only crystallises his current personal pension now as before, but also takes the full tax-free cash from his secondary plan on retirement at 66. His early and later retirement objectives are still achievable, so we're not causing any problems there, but let's consider the tax consequences. As before, we have the initial benefit crystallisation at 60. This leaves 115,000 of his LTA still available. He then crystallises his second personal pension at 66. This gives rise to an LTA charge at that time of around £40,000. However, we also have a new problem. Having crystallised all of his benefits by age 66, but drawing down only enough to meet his income requirements, this has removed the BCE5B problem we saw previously, but replaced that with a BCE5A value. BCE5A is the net gain on any previously crystallised fund, allowing for growth and withdrawals. In this case, you'll not be drawing down enough to wipe out the projected growth, and in addition to the LTA charge at 66, you will be hit with a further charge of £66,000 at age 75. So here we have a further advice problem: how to strike the balance between higher income tax in the years running up to 75 against the possibility of a BCE5A charge at 75. A further element of our LTA computation model is to look at the income tax versus LTA charge to help IFAs get this balance right as far as possible. Just as importantly, it enables advisors to demonstrate that they've taken appropriate steps to analyse the position. The analysis covers 3 time periods: the period up to state pension age, the period from state pension age to 75, which is the age that by default we assume the drawdown will be switched to an annuity, or at least matched to an annuity, and the 10-year period after age 75. Now obviously not everyone will buy an annuity at 75, and some will remain permanently in drawdown. But we know that whatever benefits are taken after 75, whether by the member or his beneficiaries, will be subject to income tax, and we therefore need to take account of the fact that by drawing more before 75, this results in less tax after 75. In this case, in the first period, the gross taxable income was reduced through the personal pension contributions to £100,000, the limit for maintaining his personal allowance. In the second period, our analysis showed that for him to meet his net income requirements, the projected average gross drawdown would be around £20,000 per annum. And along with his NHS pension and state pension, this would bring his total gross assessable income up to £69,259 per annum. In the third period, based on the projected remaining fund at 75, and using a joint life index-linked annuity rate, the aggregate gross income would be £57,127 per annum. We were therefore able to analyse the total income tax for each period. At the bottom, we can see the aggregate position for income tax with no changes to the current benefit profile, and the LTA charge, and when we factor in the changes, we will be able to see the net saving, if any. Firstly, an increase in the average drawdown between state pension age and 75. Then the consequential reduction in the value assessed for income tax in the 10 years post-75. This in turn shows the net increase in income tax, followed by the saving in LTA charge, resulting in this case in an estimated overall tax saving of around £20,000. Okay, so there's a certain amount of arbitrage between the income tax aspects and the reduction of prospective LTA, and there can be a wide range of different scenarios that may require analysis. Indeed, in some cases, even although it's clear that there's no point in incurring more income tax than the prospective LTA charge saved, but in some cases, stripping out the whole pension by 75 might create an optimal result. And this shows that type of scenario where the additional income tax is outweighed by the saving in LTA charge and optimises the overall tax position. So this is fairly complex tax planning. We've certainly had discussions with a number of firms of accountants who recognise the problem of an LTA, but they also recognise the complexities of it and this difficulty between, on the one hand, reducing taxable income, for example, through paying personal pension contributions, and on the other, the accumulation of potentially excess funds with a 55% tax hit. Also, the balance between drawdown levels from retirement to 75 and the additional tax that may give rise to, and the protection or mitigation of the LTA charge after 75 itself. And of course, there are other issues such as IHT planning and estate planning in general. So this whole area of retirement planning has become exceedingly complex, and we're certainly happy to provide assistance to any firms that feel that that would be helpful. In the meantime, thank you very much for your time.
Thank you for that, Steve. Now time to take some questions. So we're happy to receive any questions that you want to throw at Steve on this subject. I have had a couple in while you were speaking. The first one I can answer myself, which is always good. Will I get a CPD certificate for attending the webinar? Yes, you can get a CPD certificate. When you complete the survey, when you leave the webinar, there will be a question that you just tick the box to request a CPD certificate, and we'll send you that by email. Another question that had come in, Steve, that you touched on briefly was, do you think that accountants and tax advisors are actually on the ball in terms of looking at this tax charge and actually tackling it effectively or at all?
Well, it's very interesting. I had a discussion with a partner in one firm in Glasgow recently, and they were kind of caught between viewing this as a pension advice issue rather than a tax advice issue. However, we do have a number of case studies, and when he read through the case studies, he actually realised that this was not only a very serious issue, but one where his firm might potentially be exposed on the basis that the advice regarding the contributions, and this was a particular case study that caught his attention, was a SaaS scheme for a company that was profitable, and on which the company's accountants had been giving advice year on year on the amount to pay into the pension scheme in order to optimise the corporation tax position while maintaining the company's balance sheet in an appropriate fashion. And really the point is that accountants are involved in many cases in the advice process in relation to the amount being paid in, to be paid in, whether it's self-employed or whether it's private companies. And if it turns out that a tax charge arises, they can't be certain that the firm who gave the advice is still going to be around at that point in time. So this is potentially a serious problem, but it does take some effort. And we've had engagement with the various firms around the UK. It does. Their initial reaction generally is that this is not our issue, but the case studies are extremely helpful in getting them to realise that if they were involved in the advice regarding the quantum, the amount of contributions, then potentially they could be in the firing line at a later date.
Okay, thanks for that, Steve. Another question that's come in here is, and I can answer the first part of this, is the software that you use to do the case studies, is that something that we make available? Unfortunately, no, it's not. It's that's an in-house proprietary system that we don't license externally. But are you aware of anything else, any other systems out there that help to forecast and plan on? I'm not aware of any systems. I've not seen any.
No, I think in the context of LTA planning, there are we haven't seen any other systems that are out there. And one of the problems, of course, is that the LTA position is closely linked to the cash flow dynamics of the drawdown arrangement, and that in turn depends on quite a variety of things: the pattern of expenditure and retirement, how much risk is in the drawdown fund, which obviously affects the expected rate of return. So it is very fluid and it is very complex, and it does take a very sophisticated system to enable reasonable forecasting to be done, taking into account all of these various complexities. There are also other issues which are important and also are covered within the sort of analysis that we are able to provide for IFAs and their clients. There was another question come in which partly alludes to this, and that was the issue of IHT planning and the implications of dying with the funds in pension. Now, of course, the tax position in relation to death benefits has improved enormously following the recent changes in legislation, and it is certainly the case that pensions are a far more important element in the overall estate planning process than they ever were before. And indeed, we now talk about the client's pension estate and their non-pension estate, and we're looking at these in combination as to which is the best to preserve and which is best to draw down from. So in many cases now, preserving the pension fund will be more tax efficient from an estate planning point of view, and therefore drawing down more of personal assets or gifting personal assets away. I think the key point is that unless you're aware that the IHT problem is going to arise before your client reaches 75, then you hit the LTA problem at 75. So these BCE 5A and 5B tax charges apply at age 75 whether or not benefits are being crystallised or taken at that stage. So getting the estate planning the right way around is quite important, and on the assumption that a client is in reasonable health, then you need to be careful that doing IHT and estate planning doesn't create a 55% LTA charge that outweighs or diminishes the overall tax saving in the process. So the IHT bit is extremely important and should be taken into account, but don't forget the age 75 deemed benefit crystallisation events.
Okay, thanks, Steve. One final question here is where can we get the case studies? What we'll do is we've recorded this webinar and we'll host that in our technical library on the website. And we'll also host some slides there at some point, and we can send them out. If you want to get copies of the slides, just put it in your feedback form. There's a question there where you can put any generic feedback and just put slides please in there, and we'll send them to you. So it just remains for me to thank you all for attending our webinar. I hope you found it to be both informative and interesting. There will be 6 short questions when you leave the webinar, and we really do want your feedback to help us work out what, how, when we look to host future webinars and share some of the experiences that we're seeing in this brave new world of pensions and retirement planning. So thank you again for attending, and enjoy the rest of your day. Thank you.
Thank you.